Jeremy Siegel is here, Professor Emeritus of Finance, of course, at the University of Pennsylvania's Wharton School of Business. Well, this added a new wrinkle to the mix, Professor, because we now have inflationary pressure. You were just hearing from Brian as a function of what OPEC's doing. I don't know if that was in the Fed's calculus and therefore what they're going to have to do about it.
That's true, Andrew. But remember, the Fed mostly watches core inflation, which excludes the food and energy component. Secondly, thank goodness that the U.S. is virtually energy independent as compared to Europe and Japan and other parts of the world. So we do have a lot of offset. I mean, we have a lot of producers that are going to gain that aren't in other countries. We see the jump in oil stocks. I think something that was interesting to me, natural gas today, which, by the way, is more important for heating and electricity generation, actually bumped to new lows. So a lot of our energy, at least in the near term, is not going up. I actually don't think this is going to be a major issue. I mean, again, the Saudis did this to offset the decline because of the fear of recession, caused by an overtight Fed. And they're just bringing the price back up to where it was 2 months ago.
So where are you therefore on the larger equity piece of the market? We were talking to Leon Koopman earlier, and he has, let's say, a flattish to potentially dourish view, does not have a particularly bullish view on the universe, especially when you start to look at the indexes. Yeah.
Well, as I said last week, I was really disturbed. The Fed's official forecast that it gave in its March meeting is for negative GDP growth over the last 3 quarters of this year, which, of course, just started a couple of days ago. 0.4% for the year, and we're going to have 2.5% to 3% first quarter, means negative second, third, fourth quarter. It's hard to be really optimistic about equities if the Fed wants to design a negative GDP growth. Now, maybe they don't understand their own forecast. If you put it to them, did you say, hey, do you know what you just forecast there? I don't know if they'd step back from that. But certainly that was not a very encouraging forecast. If they want to be tight enough to produce that negative, it is going to be hard for equities to make progress.
Oh, and look, we've been speaking for years. You have historically been on the bullish side and, by the way, on the right side, because over time, things typically do go up over time. When you think about sort of your outlook, is that a 6-month outlook? Is that a 12-month outlook? If you had a 2 or 3 year outlook, where do things sit for you?
Well, I think, that is that would be 3, 6, 9 months. I mean, I actually think that I'm more optimistic for 2024 and 2025. I mean, I think the valuations of stocks look good to me in the long run. Long-term holders, I don't think should be frightened. But, it's hard for me until the Fed sees, what the effect. And by the way, what's interesting is that the data we're going to get the labor report later this week, and a lot of other data actually means less now than it did before SVB, because all the data we're getting now doesn't reflect the chilling effect of the banking crisis. We're not going to really get that data until very late in April and May. May 3rd is the next Fed meeting. They'll just begin to get that data. So in a way, everyone looks at the labor report. I will look at the labor report, but again, it will not reflect what has happened in the banking sector, and that's a chill that I think the Fed has to recognize.
Which means